If you put $10,000 into a gold ETF today, which one would actually grow your money more than the stock market? That's the question we're going to answer in this video. Because here's the surprising truth. While most investors are glued to the S&P 500, certain gold ETFs in 2025 have quietly doubled portfolios in less than a year. And today, I'm going to show you the 5 gold ETFs that could keep outperforming stocks and what that means for your money over the next 1, 10, 20, and even 30 years. We'll look at real numbers, performance, dividends, fees, and long-term projections. And by the end, you'll know exactly which funds give you the most powerful gold exposure without having to buy or store a single bar of gold yourself. But before we jump into the 5 ETFs, let's slow down and clear something up. Because most people have heard of ETFs, but very few actually understand how a gold ETF works. And if you don't get this part, the rest won't make sense. So let's make it simple. Think of a gold ETF as a shortcut to owning gold. Instead of walking into a shop, buying gold bars and worrying about where to store them, you buy a share of a fund that handles everything behind the scenes. Each share represents a tiny slice of the gold market. Now here's where it gets interesting. Not all gold ETFs are the same. There are 3 types of gold ETFs. Let's see them one by one. Physical gold ETFs. These funds actually hold real gold in vaults. Every share you own is backed by 99.99% pure bullion stored by banks like HSBC or JP Morgan. If gold rises 10%, your ETF rises about the same amount. Simple, stable, backed by the actual metal. Gold miner ETFs. These ETFs don't own gold at all. Instead, they own stocks of companies that mine gold. Here's why that matters. When gold rises $100, a mining company's costs don't suddenly go up, but their revenue does. That extra $100 per ounce can multiply into much bigger profits. This is called operational leverage, and it's why miner ETFs can soar 50%, 80%, even 100% when gold itself rises only 20%. Explorer ETFs. These are the wild cards. They focus on small companies exploring for new gold reserves. Riskier, yes, but if they strike gold, their stock prices can skyrocket. Explorer ETFs capture that high-risk, high-reward upside. So when you invest in a gold ETF, you're really choosing your strategy. Stability with physical gold, leverage with miners, or moonshot potential with explorers. But don't, because the 5 ETFs I have chosen cover all types of gold strategies. Now, why does all this matter right now? Because 2025 has created a perfect storm for gold. The Federal Reserve is preparing rate cuts. The dollar is weakening. Central banks are buying gold at record levels, and global tensions are fueling massive demand. That's why the gold ETFs I'm about to show you aren't just keeping up with stocks, they're crushing them. So let's dive in. The first gold ETF we need to talk about is the VanEck Junior Gold Miners ETF, ticker symbol GDXJ. This fund has been one of the best performers of 2025, with a return of more than 105% year to date. That means if you had invested $10,000 at the start of the year, you'd already be sitting on over $20,000 today. What makes GDXJ so powerful is the type of companies it holds. Instead of big established miners, it focuses on smaller junior mining companies, names like Pan American Silver, Alamos Gold, and B2 Gold. These companies are more sensitive to gold price movements. When gold rises by $100, their profits don't just increase by $100, they can rise by thousands, because their costs stay relatively fixed while revenues surge. That's called operational leverage, and it's the secret sauce behind GDXJ's explosive performance. The fund currently manages around $7 billion in assets, with more than 80 different holdings. Its expense ratio is 0.51%, which is reasonable for a specialized fund like this, and it even pays a small dividend yield of about 1.3% annually. That means you're getting paid while you wait, even as your portfolio grows. Now let's talk about the long-term potential. Based on the kind of performance we've seen in recent years, here's how a $10,000 investment could play out if the trend continues. In 1 year, you could be looking at around $20,500. Extend that to 10 years and the number grows to about $31,000. At 20 years, roughly $67,000. And in 30 years, your original $10,000 could compound to more than $130,000. These aren't guarantees, of course, but they give you an idea of just how powerful junior miners can be when gold is in a super cycle. Second ETF is VanEck Gold Miners ETF, ticker GDX. If GDXJ is the high-octane play on junior miners, then GDX is its steadier, more established counterpart. The VanEck Gold Miners ETF focuses on the giants of the industry, companies like Newmont Corporation, Barrick Gold, and Agnico Eagle. These are the household names of gold mining, with operations spread across multiple continents and decades of experience in navigating commodity cycles. So far, in 2025, GDX has delivered an incredible performance of about 99% year to date. The fund itself is massive, with nearly $20 billion under management, making it one of the largest gold mining ETFs in the world. It holds about 65 different companies, but the top 10 account for almost 2/3 of the total weight. That concentration means your money is directly tied to the biggest and best-run miners in the world. The expense ratio is 0.51%, the same as GDXJ, but you also get a dividend yield of about 0.9%. Not huge, but a steady payout on top of strong price appreciation. Now let's look at projections. If you start with $10,000, here's what the math shows. After 1 year, assuming performance similar to this year continues, you'd be close to $19,900. Stretch that over 10 years, with a strong but slightly lower growth rate than juniors. Your money could grow to around $29,000. In 20 years, you'd be looking at about $61,000. And by 30 years, that same $10,000 could become roughly $122,000. So far, we've looked at junior miners and the big established players. But what if you want your gold exposure spread across the globe? That's where Ring, the iShares MSCI Global Gold Miners ETF, comes in. Unlike GDX, which is heavily North American, RING casts a wider net. It invests in miners from Canada, Australia, South Africa, and beyond, giving you diversification that stretches far beyond US borders. In 2025, Ring has been just as impressive as its peers. Year to date, it's up more than 105%. One of Ring's big advantages is cost. Its expense ratio is only 0.39%, noticeably lower than both GDX and GDXJ, which charge 0.51%. Over the years, those fee differences really matter, because the less you pay in expenses, the more of your returns stay in your pocket. On top of that, Ring pays out a dividend yield of around 0.85%, which is an extra layer of return on top of price growth. The fund itself holds around 40 companies, with heavyweights like Newmont and Barrick Gold still in the mix, but also exposure to overseas names you won't find as prominently in the North American ETFs. Assets under management sit in the billions, making it liquid and easy to trade. Now let's look at the projections. If you invest $10,000, here's what you might expect if momentum continues. After 1 year, your investment would be worth roughly $20,500. Over 10 years, assuming strong returns, but factoring in some global variability, that number grows to about $29,000. By 20 years, you'd be looking at around $61,000, and in 30 years, about $122,000. Very similar to GDX, but with the added benefit of lower costs and international diversification. While GDX and RING give you broad exposure to the gold mining sector, the Sprott Gold Miners ETF, ticker SGDM, takes a more selective approach. Instead of simply tracking the biggest companies by market cap, SGDM uses a factor-based strategy to pick miners with stronger fundamentals. In other words, it tilts toward companies with higher revenue growth, better balance sheets, and solid operating performance. That makes it a bit more focused than the other ETFs we've discussed so far. In 2025, that strategy has paid off. SGDM is up more than 105% year to date, right in line with the best performers in the sector. The fund isn't as large as GDX or GDXJ, but it still manages a healthy pool of assets in the billions. It holds just over 24 companies, which means each position carries more weight compared to the broader ETFs with 60 to 80 holdings. Its expense ratio sits at 0.5%, almost identical to GDX, and the dividend yield is smaller, at around 0.6% annually. Now let's run the numbers forward. If you invest $10,000 in SGDM, here's what it could look like. After 1 year, you'd have about $20,500, assuming similar performance. Over 10 years, projecting a strong 11% average annual growth rate, that $10,000 could grow to roughly $28,000. In 20 years, you'd be looking at around $72,000. And in 30 years, close to $137,000. The concentration gives SGDM the potential to outperform, but it also makes the swings sharper. If GDX and RING give you stability and GDXJ gives you leverage, then GOEX is the wild card. The Global X Gold Explorers ETF invests in companies that aren't just mining gold today, but are actively searching for new deposits. These are the high-risk, high-reward players of the gold world. When they make a discovery, their stock prices can skyrocket. When they don't, the drop can be just as dramatic. That risk has come with big rewards in 2025. GoEx is up more than 106% year to date. The fund holds around 50 companies, many of them smaller names you won't see in GDX or RING. Assets under management are smaller than the big funds, but still provide enough liquidity for everyday investors. The expense ratio is higher, at about 0.65%, which reflects the specialized exposure you're getting. The dividend yield is very modest, just 0.4%, because most of these companies reinvest profits into exploration instead of paying out shareholders. Now let's look at projections. If $10,000 had been invested in GoEx, here's how it could play out. After 1 year, with returns similar to 2025, you'd have about $20,600. Over 10 years, assuming an aggressive 12% average annual return, your investment could grow to around $31,000. In 20 years, that same $10,000 could reach about $96,000. And in 30 years, you'd be looking at roughly $300,000. Those numbers show the extreme compounding power if exploration companies keep hitting new reserves. If you want these gains to actually turn into lifelong wealth, don't stop here. Click the video on your screen. In that one, I'll show a simple system to compound returns step by step, so your money grows faster and smarter.